Imagine buying a stock at $100, and a year later it's at $300. Your friends ask for your secret formula. You tell them, I just bought AI, and suddenly they hate you just a little bit. Because AI stocks aren't crawling up anymore. They're sprinting. We're talking 200% gains in a single year for some of the biggest names in tech. And if you've been sitting on the sidelines, the question gnaws at you. Is it too late to get rich? Asbim. Here's the uncomfortable truth. The AI boom isn't just another trend. It's an industrial revolution in a hoodie. From chipmakers designing silicon brains to software giants building tools that write, code, and trade stocks, this thing has roots in every corner of the market. Take NVIDIA. 12 months ago, analysts said its valuation was too high. Now it's doubled, because the world realized you can't run advanced AI without its chips. They don't just sell hardware. They sell the picks and shovels for the entire AI gold rush. Then there's Microsoft, quietly integrating AI into everything from Excel to Azure cloud services. Every new feature locks customers deeper into its ecosystem, turning optional AI into a utility, like electricity, but with more passive-aggressive autocorrect. And the wild part? These aren't penny stocks. These are trillion-dollar companies doubling in value while paying dividends. That's like your rich uncle making another fortune just by showing up to work. Scheiß. But not all AI winners are household names. Mid-cap companies in AI cybersecurity, autonomous robotics, and generative media have been quietly printing gains. Take C3.ai, once written off as overhyped, now riding enterprise demand for predictive analytics. Or Palantir, a company that used to sound like a Lord of the Rings fan project, now securing massive government AI contracts. These players have smaller market caps, which means when they catch a big contract or release breakthrough tech, their stock moves like it's on a trampoline. Aussie. So, should you jump in? Here's the problem. Every bubble in history looks unstoppable until it doesn't. Remember dot-com stocks in 1999? Tulips in 1637? At some point, valuations stretch so far from reality that gravity becomes inevitable. AI is no different. Some of these companies are priced for perfection, as if growth will continue forever without hiccups. If they miss earnings, lose a contract, or just sneeze in the wrong direction, you'll see those 200% gains deflate faster than a leaky, bouncy castle. The smart money knows this. They're not buying every AI stock. They're buying the ones with three things. Real, defensible technology that competitors can't easily copy. Scalable business models that don't collapse when demand spikes. And actual profits, because revenue growth without profit is just expensive charity work for shareholders. In other words, they're avoiding the shiny AI startups that spend $2 to make $1, no matter how slick their press releases look. Miami. And here's a twist nobody's talking about. The real money might not even be in AI companies themselves, but in the infrastructure behind them. Chip foundries like TSMC. Data center REITs building server farms the size of football stadiums. Even energy companies, because AI training burns through electricity like a small nation binge-watching Netflix. These are the boring businesses that get paid whether AI succeeds spectacularly or just becomes an overpriced office assistant. Chaji. But here's the thing about too late. It's only too late if you expect lightning-fast lottery-style gains from here. Yes, the biggest wave of early profits has passed. Yes, buying after a 200% rally carries risk. But the AI trend isn't a 12-month story. It's a decades-long one. Think of the internet. If you bought Amazon in 2001 after the dot-com crash, you were late by early adopter standards, yet you still would have made 300x your money. Sometimes being late just means missing the crazy, sleepless phase of growth and catching the stable, compounding phase instead. Of course, there's the dark side. AI regulation is coming, from data privacy laws to limits on autonomous decision-making. A single bill passed in Washington or Brussels can hit valuations overnight. And because AI is so interconnected, a slowdown in one sector, say autonomous driving, can ripple through suppliers, chip makers, and software partners instantly. If you're in AI stocks, you're not just betting on innovation. You're betting on politics, ethics, and public opinion not turning against the machines. Asha. So is it too late? If you're expecting another 200% in the next 12 months, probably. If you're thinking long-term, building a portfolio with leaders, infrastructure plays, and a few speculative moonshots, the runway's still there. Just remember, the AI market doesn't care about your FOMO. It doesn't reward panic buys at the top. It rewards patience, research, and buying when everyone else is convinced the robots are overrated. Right now, as some investors cash out their triple-digit gains, others are quietly positioning for the next leg of growth, the part where AI moves from flashy tech headlines to invisible, everyday necessity. And when that happens, the real fortunes won't be made by the loudest voices shouting, "Buy now." They'll be made by the ones who bought while you were still deciding whether it was too late.